Real estate has created more millionaires in America than any other asset class in history. And yet, when you run the actual math, you might be better off never buying a single property. That's not an opinion. That's what the numbers say. And by the end of this video, you're going to see exactly why. Now, I'm guessing you know someone like this. A coworker who just closed on a rental property. Won't stop talking about it. Passive income, cash flow, generational wealth, every lunch break, every conversation. Meanwhile, your other friend just hit $200,000 in his index fund and he's got a completely different gospel. Real estate is overrated. Too much work, too many hidden costs. The stock market compounds while you sleep. So there you are, sitting in the middle of two very loud, very confident people with no idea who's actually right. Here's the thing, they're both cherry picking. Your coworker is showing you the upside and hiding the costs. Your friend is showing you the returns and hiding the risk. Nobody is sitting down and running the real numbers until today. I'm going to show you a simulation most real estate investors don't want you to see, and a number most stock market fans are too optimistic to admit. No courses, no affiliate links, no agenda. Just the math that makes both sides uncomfortable. Let's get into it. Let me hit you with a number right out of the gate. Over the last 100 years, after adjusting for inflation, the average American home has appreciated at roughly 1% to 2% per year. Not 10%, not 15%, not I bought in 2012 and tripled my money, 1 to 2%. That's from the Case-Shiller Home Price Index, one of the most comprehensive real estate data sets in existence. 100 years of data across the entire country. Now compare that to the S&P 500. Over the same period, after inflation, the stock market has returned roughly 7% per year on average. 7% versus 1, 2%. That gap is not small. That gap, compounded over 30 years, is the difference between a retirement and a struggle. So why does everyone keep saying real estate is the greatest wealth builder of all time? Two reasons. First, people confuse their home going from $200,000 to $500,000 with a good investment return. They see the big number. They forget about inflation. They forget about everything they spent in between. They just see the difference and call it a win. Second, and this is where it actually gets interesting, they're not wrong about one thing: leverage. When you buy a $300,000 house with 60,000 down, you're not investing $300,000. You're investing $60,000 and controlling $300,000 worth of asset. That changes the math completely. And that's exactly what we're going to run through in this video. But here's what I need you to understand before we get there. That 1-2% real return, that's before costs. And the costs, nobody talks about the costs because when you stack them up layer by layer, the number that comes out the other side is going to make you question everything you thought you knew about real estate. Let's start stacking. Let's talk about how both sides lie to you. Not maliciously, not intentionally, but they both do it every single time. And once you see it, you can't unsee it. The real estate side starts with a story. I bought my house in 2010 for $180,000. It's worth $520,000 today. That's almost a 200% return. Sounds incredible. And on the surface, it is. But here's what that calculation is missing: inflation, time. And every single dollar that went into that house between 2010 and today. When you strip out inflation, that $520,000 in today's dollars is worth significantly less than it looks. And when you factor in everything spent on mortgage interest, property taxes, insurance, maintenance, which we'll get to in the next section, that 200% starts looking a lot more like 40%, maybe less. That's not a return. That's barely keeping up. Now, the stock market side does the same thing, just in the opposite direction. The S&P 500 averages 10% per year. Just invest and let it compound. Technically true, but that's the nominal number before inflation. After inflation, you're looking at around 7%. Still great, but not 10%. And here's the part they skip. Not everyone actually gets that 7%, because getting 7% requires you to do something most people cannot do: stay invested. Through 2001, through 2008, through March 2020 when the market dropped 34% in 33 days. Through every moment, your account is down $40,000 and everything in your brain is screaming at you to sell. The average investor, according to Dalbar's annual study, has historically underperformed the S&P 500 by 3 to 4 percentage points per year. Not because the market failed them, because they panicked and sold at the wrong time. So let's be honest about what we're actually comparing. Real estate, 1 to 2% real appreciation per year, before costs, before leverage. Stocks, 7% real return per year, before behavior, before panic selling. Neither number is the full story. But here's where it gets interesting. Real estate has one weapon that stocks simply don't have. You can borrow $240,000 from a bank at a fixed rate to control a $300,000 asset. And if that asset goes up even 3% a year, Your actual return on the $60,000 you put in is dramatically higher than 3%. That's leverage, and it's the reason this comparison is nowhere near as simple as either side makes it sound. But before we run that simulation, we need to talk about the costs, because leverage cuts both ways. And the costs are what nobody puts on the whiteboard when they're selling you the dream. Let's talk about the costs nobody puts in the brochure. Because when someone sells you the dream of real estate, they show you the appreciation. They show you the rental income. They show you the equity. They never show you this. Let's take a $300,000 house, pretty average for most mid-sized American cities right now. And let's stack every cost, layer by layer, the way they actually hit you in real life. Layer 1, property tax. The average effective property tax rate in the United States is around 1% to 1.5% of the home's value per year. On a $300,000 house, that's $3,000 to $4,500 every single year. And that number goes up as your home's value goes up. You don't get to opt out. You don't get a break. It shows up every year, whether the house made you money or not. Layer 2, homeowners insurance. Average cost in the US right now, around $1,500 to $2,200 per year. And with climate risk increasing across the country, that number is climbing fast. In some states like Florida and California, people are getting dropped by their insurers by entirely. Layer 3, maintenance. This is the one that kills people. The standard rule of thumb is 1% to 2% of your home's value per year in maintenance costs. On a $300,000 house, that's $3,000 to $6,000 per year. And that's not a renovation. That's just keeping the house from falling apart. The roof doesn't care about your cash flow goals. The HVAC doesn't care about your 5-year plan. They break when they break. Layer 4, transaction costs. This one hits you at the beginning and at the end, and most people forget to count it. Buying a home closing costs typically run 2% to 5% of the purchase price. Selling agent commissions plus closing costs run another 6% to 8%. On a $300,000 purchase and a $600,000 sale, you're looking at $6,000 to $15,000 going in, and $36,000 to $48,000 coming out. That's $42,000 to $63,000 that never shows up in the I doubled my money calculation. Now let's add it all up. Property tax over 30 years, conservatively $120,000. Insurance, $60,000. Maintenance, $135,000. Transaction costs, $50,000. That's $365,000 in costs on top of your mortgage before you count a single dollar of interest. And we haven't even talked about interest yet. Now compare that to stocks. The expense ratio on a Vanguard S&P 500 index fund is 0.03% per year. On a $300,000 portfolio, that's $90 per year. $90 versus $12,000 to $15,000 per year in carrying costs for the house. Nobody puts that on the whiteboard when they're selling you the dream. And here's the thing, this still isn't the full picture because we haven't run the simulation yet. We haven't put real numbers against real numbers, same starting capital, same time horizon, same human being, and asked the one question that actually matters. Which one leaves you with more money after 30 years? That's next. All right, this is the section both sides have been dreading. No more theory, no more cherry-picked numbers. No more, well, it depends. We're going to take the same person, the same starting capital, the same 30 years, and we're going to run two simulations side by side, as honestly as I possibly can. Let's meet our investor. His name is Marcus. He's 30 years old. He has $60,000 saved. He makes $75,000 a year. He's trying to decide right now whether to put that $60,000 into real estate or into the stock market. This is the decision that will define the next 30 years of his financial life. Let's run both paths. Path A, Marcus buys a house. He finds a $300,000 home, puts 20% down. That's his $60,000. He takes out a $240,000 mortgage at 7% interest over 30 years. His monthly mortgage payment, principal and interest, comes out to $1,597 per month. Now remember section 3. We stack the real costs on top. Property tax, $300 per month. Insurance, $150 per month. Maintenance, $375 per month on average. His total monthly housing cost, $422 per month, not $422. Now let's talk about what happens at the end. 30 years later, Marcus sells. Let's be generous. Let's say his home appreciated at 3% per year nominally. That takes his $300,000 house to roughly $728,000. Sounds great. Now subtract. Total interest paid over 30 years, $334,000. Total property tax, $120,000. Total insurance, $54,000. Total maintenance, $135,000. Transaction costs buying and selling, $50,000. Total costs, $693,000. Marcus's net profit after 30 years, $728,000 minus $300,000 original price minus $693,000 in costs. That's a loss of 265,000 on paper. Wait, but he put in $60,000 and controlled a $300,000 asset. So his return on invested capital is actually higher than that raw number suggests. Let's be fair. His equity position, what he actually walks away with after paying off the mortgage and all costs, is approximately $295,000 to $320,000 net. That's on $60,000 invested 30 years ago. Not bad. But hold on. Path B, Marcus invests in the stock market. Same $60,000 goes into a low-cost S&P 500 index fund on day one. But here's the key variable most people miss. Marcus isn't spending $2,422 per month on housing costs. He's renting instead, let's say $1,500 per month in a comparable area. That leaves him $922 a month, the difference between owning and renting, to invest every single month into that same index fund. $60,000 up front, $922 per month, 7% real annual return, 30 years. Let's run that math. The $60,000 upfront alone at 7% for 30 years grows to approximately $457,000. The $922 monthly contributions at 7% for 30 years grow to approximately $1,060,000. Total portfolio value after 30 years, roughly $1,517,000. Expense ratio costs, negligible. Less than $5,000 total over the entire period. Net position, approximately $100,000. Let's put those side by side. Path A, real estate, net walkaway, $295,000 to $320,000. Path B, stocks, net walkaway, approximately $1,500,000. That is not a small difference. That is a life-changing difference. That is the difference between supplementing your retirement and never having to worry about money again. Now, before the real estate side of the room loses their mind, I hear you. This simulation has assumptions. Marcus was renting, not living in the house. The rent number matters, the appreciation rate matters. And there are scenarios, specific markets, specific timing, specific strategies where real estate absolutely wins. We're going to get to that, but I need you to sit with this number for a second. Because most people spend their entire adult life believing that buying a house is automatically the smartest financial decision they can make. And the math, honest, complete math, says something very different. The math says it depends entirely on what you do with the difference. If Marcus rents and blows the 922s every month on adding out in subscriptions, Path B collapses. Stocks don't win. Nothing wins. But if Marcus is disciplined, if he actually invests that difference every single month for 30 years, it's not even close. Now, I know what the real estate side is thinking. You forgot about leverage. That's the whole point. That's the unfair advantage that stocks will never have. And you're right. Leverage is real. Leverage is powerful. And leverage deserves an honest conversation, not the glossy version you hear at real estate seminars. So let's talk about it honestly. When Marcus puts $60,000 down on a $300,000 house, he's not investing $300,000. He's controlling $300,000 with $60,000. That's a 5-to-1 leverage ratio. If that house goes up 10% from $300,000 to $330,000, Marcus didn't make 10% on his money. He made $30,000 on a $60,000 investment. That's a 50% return on his actual capital. That is genuinely powerful. That is something the stock market, unless you're using margin, simply cannot replicate at that scale for the average person. And in a rising market with low interest rates, strong appreciation, good rental income, leverage turns real estate into a wealth building machine. That part is true. Here's the part they leave out. Leverage doesn't just amplify gains, it amplifies everything. If that same $300,000 house drops 20% in value, which happened in markets across America between 2007 and 2009, Marcus doesn't lose 20%. He loses $60,000 on a $60,000 investment. That's 100% of his capital. Gone. And it gets worse. Because unlike stocks, where a 20% drop means your account looks bad, but you still own your shares, a 20% drop in real estate combined with one bad life event can trigger a complete collapse. Think about what happened to millions of Americans in 2008. Values dropped, jobs disappeared. And suddenly, people who thought they were building wealth found themselves underwater on a mortgage they couldn't afford, on an asset they couldn't sell, in a market that had frozen completely. They didn't just lose money. They lost the house. They lost the down payment. They lost years of mortgage payments. They lost their credit. Some of them lost everything. Leverage did that. Not bad luck. Not a black swan nobody could see coming. Leverage, amplifying a downturn into a catastrophe. Now, here's the critical distinction. If Marcus has $300,000 in the stock market and it drops 20%, his account shows $240,000. It feels terrible. But he still owns his every single share, so he can hold, he can wait, he can recover. History says he will recover. But if Marcus has $60,000 of equity in a $300,000 house and the house drops 20%, his equity is gone. And if he loses his job at the same time, he can't hold. He can't wait. The bank doesn't care about recovery timelines. That's the leverage trap. Not that leverage is bad, but that leverage is a risk multiplier, not a free lunch. In the real estate seminars, they sell you the upside. They hand you the brochure with the 50% return story. They don't show you the 2008 chapter. There's one more variable that never shows up in any return calculation. It doesn't appear in the simulation. It doesn't show up in the Case-Shiller index. Nobody puts it in the brochure. But it has destroyed more financial plans than bad investments, bad timing, and bad advice combined. It's called liquidity. And most people don't think about it until the moment they desperately need it. Let me show you exactly what I mean. It's March 2020. The world is shutting down.
Marcus, Path A Marcus, the homeowner, just lost his job.
His emergency fund covers 3 months. He has $400,000 in home equity sitting in his house. He is not broke on paper. He is actually quite wealthy on paper. But paper wealth doesn't pay the mortgage. He tries to sell, but the market just froze. Buyers disappeared overnight. His realtor tells him it could take 60 to 90 days minimum if he gets an offer at all. He tries to get a HELOC, a home equity line of credit, to pull some of that equity out as cash. The bank says, no, you're unemployed. We can't approve you. Month 1, he drains his savings. Month 2, he puts groceries on a credit card. Month 3, he misses a mortgage payment. Month 6, the bank begins foreclosure proceedings. Month 9, Marcus loses the house. He loses the equity. He loses everything he spent the last decade building. $400,000 in paper wealth. Gone. Not because the asset was bad, because he couldn't access it when he needed it most. Now let's look at Path B Marcus, the investor. Same month, March 2020, same job loss. He opens his brokerage account. His portfolio is down. The market just crashed 34%, but he still has $280,000 sitting there in index funds. He sells $15,000 worth of shares. It takes 3 seconds. The money hits his account in 2 business days. He pays his rent, he buys groceries, he keeps his life intact while he finds a new job. 6 months later, the market has fully recovered. His portfolio is back. His life is intact. His credit is untouched. Same financial crisis, completely different outcome. That's liquidity. It's not sexy. It doesn't show up in return calculations, but it is the single most underrated variable in this entire debate. Because illiquidity doesn't just cost you money. Sometimes it costs you everything. So who actually wins? I'm not going to give you the it depends answer every other finance video hides behind. Here's the real verdict. If you are under 35, have a stable income, and don't have the capital or the bandwidth to actively manage a property, the math is not close. Stocks win consistently, significantly, and with a fraction of the stress. If you have high income, strong cash reserves, the ability to absorb a downturn without panic, and you're buying in a market with genuine rental demand, real estate can be a powerful wealth building tool, especially when you use leverage responsibly and hold long term. And if you're buying a home to live in, that's a completely different conversation. That's a lifestyle decision, a stability decision, a family decision. Just don't call it an investment. Call it what it is, a place to live that happens to build some equity over time. That's not a bad thing, but it's not the same as an investment strategy. Here's the truth that makes both sides uncomfortable. Most people who say real estate made them rich got lucky on timing, not strategy. They bought in 2010 or 2012 or 2015 in the right market and rode a historic wave. And most people who say stocks don't work never actually stayed invested long enough to let compounding do its job. The asset doesn't make you wealthy. The behavior does. Look, this was never really about real estate versus stocks. It's about understanding what you're actually buying into. The real costs, the real risks, the real math, not the version someone shows you when they're trying to sell you something. People don't fail financially because they picked the wrong asset. They fail because they made a $300,000 decision based on a conversation at a barbecue because they saw a coworker get rich and assumed the same strategy would work for them because nobody sat them down and ran the actual numbers. That's what this video is about. Not telling you what to do, but giving you the complete math so that whatever you decide with your eyes open. Smart isn't picking the winning asset class. Smart is understanding the game each one is playing and deciding which game fits your life, your income, and your ability to sleep at night. Because the worst investment isn't real estate. It's not stocks either. The worst investment is the one you don't fully understand, made under pressure, made out of fear of missing out, made because everyone else was doing it. Run the math, know the costs, understand the risks. And if this video helped you see any part of this more clearly, hit subscribe. This is exactly what I put out every single week. No fluff, no hype, just real numbers for real decisions. I'll see you in the next one.